Hi, traders. Welcome to Market Outlook, Trends, Risk Events, and Trade Setups brought to you by Vantage Markets. This is a weekly webinar where we focus on what's been happening in markets and what is about to happen in the week ahead. Well, so I just let you have a quick look at the disclaimer. I'll just run through what we hope to get through in the next 30 to 40 minutes or so. Pretty busy webinar, actually, obviously, with last week's jam-packed week full of risk events and central bank meetings, of course, earnings as well. So we'll look at all of those. And before that, we'll just check out how markets are trading currently. As I say, then we'll look at all last week's main events, just review those as a lot went on. Of course, we'll look at the central bank meetings, the Fed, of course, cut rates, the ECB and Bank of Japan were on hold. So we'll look at those and we'll look at all the associated currencies as well. Before that as well, we'll look at the earnings from some of the mega cap tech titans. So we'll look at, just a summary of what's came out there and also the charts and what they're telling us. Then we'll look, as I say, at last week's main event. Sorry, a bit mixed up there. Last week's other main events. So the central bank meetings, Fed, ECB, Bank of Canada as well, actually, and the Bank of Japan. So we'll look at all of those and the associated currencies, as I say, before then getting into just a couple of central bank meetings actually for this week as well. So we'll preview those towards the end of the webinar. That is the RBA and also the Bank of England meeting. So we'll look at the Aussie dollar, sterling against the dollar, and wrap it up there, hopefully in 30 to 40 minutes. So as I say, a lot to get through. There we are. There's what we hope to get through. And I'm just checking out where markets are trading currently. I should say, if you do have any questions along the way, please do ask them, and we'll try and answer those as we go. Any questions that you have, what we're talking about, what you're looking at, setups, etc., then please do ask questions. Always more than happy to answer them. We'll try to answer them as we go, as I say. Markets then generally pretty buoyant, actually. European bourses, stock markets are firmer, and US equity futures firmer as well. So more record highs potentially. The EU-China trade developments are positive and constructive. And just checking the dollar, marginally higher, actually, with the dollar index eyeing 100. We'll get through or have a look at the dollar index chart shortly. The Swiss franc hampered by CPI data. Bonds are relatively contained, actually. A lot of central banks speaking or officials speaking this week. We also get ISM manufacturing data out later. Crude, just checking that, reverses initial gains, actually, after OPEC Plus opted to raise outputs again by a modest 137,000 barrels per day in December before pausing in Q1 of next year. Gold pretty flat, actually, just above 4,000, while base metals digest disappointing Chinese manufacturing PMI data. So first up really is, equities and the Mag 7. I've got a couple of charts here, which we used actually last week, which was this one actually. So just showing the outperformance currently of the Mag 7 versus the rest of the market. You can see there, just around sort of summertime, Mag 7 performance actually dipped. So you can see the orange line and the black line sort of touching each other, but then the orange line then has pushed higher above the black line being the 493 stocks of the S&P 500, and then the Mag 7 being obviously the tech mega cap stocks. So interesting chart, and that has continued really after earnings. So here you just see where the Mag 7 are now after earnings, and as a little bit of a dip, but we're pretty much close to those highs relative to the other 493 stocks. Equities just briefly on Friday were mixed, actually, and generally mixed through the week. So Asia continued to impress more broadly. The Korean Kospi actually up 7% last week, just in a single week. US stock markets, they did climb. So S&P 500 was up 0.3% on Friday. That was helped by Amazon's double-digit gain after its earnings report. And S&P 500 stocks then were up just over 1% for the week. Europe lagged behind, trading sort of low on Friday and for the week. And we closed out then the month with a sixth straight increase monthly gain win streak actually in the S&P, and we'll look at that shortly. There was optimism, of course, around the Fed rate cut, even though we'll see that Powell pushed back against that or pushed back against the December rate cuts, but still it didn't hold back equities. We also had, of course, the trade agreement or the trade tensions coming down really between the US and China. US President Trump, of course, he gave a debrief after his meeting with President Xi. He rated the meeting 12 out of 10, with basically the two agreeing to meet again in China in April. Most other headlines matched kind of the chatter in the run-up, really. US tariffs on China will be 47% down from 57% because of lower fentanyl-related charges. Trump also touted agreement on soybeans and other agricultural products. There were this was crucial really, no roadblock on rare earths. Discussion on chips, spoil accounts, although that was vague, and then the postponement of US shipbuilding probes. All pretty positive then, and the risk rally really has kept on going. If we next look at, well, this is an interesting chart, really, we thought we'd throw in there. It's got the Goldman Sachs index in the blue, which is data center and related other infrastructure. I've called it AI infrastructure, really, against, the Mag 7, the gray line, and then the black line is the S&P 500, the broader index. You can just see how well the AI infrastructure stocks and the index have done, how well they have outperformed really since sort of May, June time. Interesting then, we got obviously those big Mag 7, 5 of the Mag 7 reporting last week. If I just go through them in turn, and I'll pull up a couple of charts as well. Just bear with me 1 second. Before I get to the charts, actually, generally, sort of summary would be AI momentum, of course, is real, but it is slightly uneven. So we have big tech names, of course, they remain the backbone of the AI cycle. But leadership is splitting between those basically monetizing AI now and those still building capacity. And that's kind of what we saw with Meta closing much lower, whereas AWS and Amazon, they closed higher, as well as Alphabet. Profits are high, of course, but valuations are probably higher, really. Backlogs and earnings do justify holding exposures, of course, but then elevated valuations also then increase the risk of a pullback if growth expectations are not met. So really, you have to be kind of careful weighing potential downside before really adjusting positions. That's kind of the view. As I say, then if we go through each MAMA is basically what it was last week. Meta, Alphabet, Microsoft on Wednesday after the close last week, and then we had Amazon and Apple after the Thursday US close. First up, Meta. Should we get to that one? And let me grab the chart. So bear with me 1 second. So Meta didn't have a good week, as I've said. Here is the chart, which you can see. If I just pull off these, count the channels, you can just see that gap lower. We closed, it was down, I think, around 8% pre-market open, Meta, and then closed down 11% actually in the end, 11.3% on the day. And then we also closed on Friday down 2.7%. Basically, it warned it would have to increase its spending on AI infrastructure in order to follow basically Mark Zuckerberg's ambitious plans really to create a so-called personal superintelligence. It did beat, though, 51.24 billion in quarterly revenue. That beat expectations, but then it did miss massively on EPS, $1.05 versus an expected $6.70, although that was due to a one-time charge of 15.9 billion. If you took that out, actually, the EPS outperformed analyst estimates of that $6.70. But markets really focused on that increase in spending, potentially too ambitious plans, and markets then investors having to wait too long for something that is still quite uncertain. The stock got punished, and you can just see then we closed open below actually the 200-day moving average, which is that black line. That's at 678.54. That tallies with this Fibonacci retracement level of the lows in April up to those record highs in August. Fib level there, 38.2 is at 675.37. So potentially a zone of resistance there. Otherwise, next support, potentially the halfway point of this move higher. That's around 638.03, I think. So interesting, really, whether Meta can find some support or whether it will hit that resistance again around 678, 675. If it does break that, then we're back sort of towards potentially 700 and beyond that. That blue line is the 50-day moving average. That's at 738.60. Otherwise, we also had Microsoft. Let me pull up that chart. They were actually a new member of the $4 trillion market cap most recently. They dropped over 3% pre-market open, really, after releasing their quarterly results on that Wednesday, as I said, after the close. Quarterly revenue boosted by cloud sales topped analyst estimates, even as its CapEx, so its capital expenditures, surged nearly 75% from a year earlier. Investors again now wondering if these revenue gains have been bought at too high and perhaps too unsustainable costs. And that's again markets punishing those reasons. Really interesting that now CapEx was once seen and growth in CapEx on AI infrastructure once seen as a sort of a badge of honor, really, if you like. And now potentially, as we're not seeing any of those gains for the time being, then stocks are getting punished. You can just see then the blue line's the 50-day moving average. We look to support there. That's at 513.83. Microsoft this is. Otherwise, you've got that, I think it's an all-time high, 553.72. No, the all-time high is 555.45, actually. So if we do find support around 513, then potentially we can push higher up above 540 and 550. That was Microsoft. Alphabet. Let's pull up that chart, which is obviously Goog as the ticker. Flip side, really, to those two reports, Meta and Microsoft. Stock soared over, 8% to fresh all-time highs, actually, pre-market open on October 30. It announced basically its first $100 billion quarterly revenue. EPS easily beat the projected $2.27. That came in at $2.87. Investors really see the $155 billion cloud backlog as providing really strong future guidance, really a strong guide to future performance, essentially. And then even AI tools like Gemini, with now 650 million monthly active users, they are producing real business results. The stock was rewarded, and you can just see pushed up to 291.93, that all-time high then. And now we just pulled back actually on Friday to around 281.82. We are overbought on that stock. You can see the daily RSI at 78. So interesting whether we do get a little bit of a correction. Otherwise, doesn't mean we can't go higher towards 300. Then just looking at the Thursday results, Amazon and Apple. Amazon shot higher. Let's just pull up that chart. You can just see finished up over 9.5% on the day to record highs. It touched 250 and 50 cents actually before then pulling back to 244, but still up 9 1.5% on the day. Smashed expectations. Essentially, Q3 net sales, they jumped 13% to $180 billion. And then AWS, its cloud unit, really key, that surged 20% to $33 billion. That was its fastest growth in 3 years. AI, of course, and data centers driving the Amazon story, really. The CEO, he said, demand for AI and cloud infrastructure is booming, with a focus on increasing capacity even. That really excited investors, of course. And then the market cap actually now about $2.4 trillion. They also gave a bullish outlook for Q4 sales, $206 to $213 billion in Q4 sales. That's up 13.13% compared to a year earlier. Markets rewarded that, as I say, up 9.5%, and we're into sort of blue sky territory, really. I guess the previous high from back in February was 242.52. And then we've got this high from September at 238.85. They could be support in case we see a little bit of a pullback. We're not overbought on the daily RSI, so potentially with the index going higher, then this pushes through 250. Otherwise, Apple, just quickly, let's check out the chart. That did push up to new all-time highs nicely in this ascending bull channel. You can see here from the lows in sort of August time. We got up to 277.32 there on the chart, and still in the sort of bull channel, really. Apple basically delivered record revenues of 102.5 billion. That was up 8% compared to a year earlier. Quite astounding, really, because it wasn't it was a non-holiday season. Just remember that. Small miss in iPhone sales numbers. And a $2 billion miss in China sales, actually, compared with estimates. But then the CFO basically said later that Apple expects a 10 to 12% revenue climb in the coming holiday quarter, essentially driven by strong iPhone 17 demand and also record services income. So pretty sort of interesting stock, Apple, now, really sort of very much a steadier stock in a way, but obviously boosted by services income for sure. Not really an pure AI sort of infrastructure play, and we're still kind of waiting for more news on that in a sense. But at the moment, delivering the goods really on the iPhone 17 launch, actually, and then, as I say, record services income as well. Previous high, you can see 260.10. That sort of capped the upside through sort of early October, but then we blasted through that, hung around there, bullish consolidation before another push higher. I should say we do have other earnings, pretty big earnings this week. We have Palantir out after the close tonight, AMD, Qualcomm. So they'll be interesting for the tech side, really. And then we do have other results like McDonald's, consumer sort of sentiment stock, really. Robinhood could be interesting as well. Airbnb, I think Time Warner, News Corp. So a fair percentage of other non sort of Mag 7 stocks, but still important for investors, especially as we have this sort of dearth of data. No US economic data because of the government shutdown. So potentially more focus on some of these earnings. Okay, I'm going to just move on then to yes, the central bank meetings from last week. Next up. So bear with me 1 second. Yeah, so central bank meetings, of course, there were a plethora of those last week. Oh, sorry, bear with me. It's playing up. Yeah. We had the Fed, ECB, Bank of Japan, Bank of Canada, of course. A few charts here, and let's just go through the Fed, really. That was the main event, certainly, and kind of lived up to its hype, actually, of being slightly volatile. They delivered their 25 basis point rate cut. Of course, they did. That brings the midpoint now to 3.875%. So between 3.75% and 4%. They did also announce an end to quantitative tightening from December 1st. That was expected by many, actually. But the move wasn't unanimous, of course. The rate cut move wasn't unanimous. That was kind of expected, but still, this sort of differences in or on the FOMC are fairly rare historically, just to point out. So Governor Mirren, he pushed for a deeper 50 basis point cut, whilst actually Kansas City Fed's Schmidt, he preferred actually to hold rates steady. So really a clear sign of a divided committee, actually. And even Chair Powell, he said in his press conference later, actually, that there were strongly differing views. And that is quite important, actually, for a Fed, which is very normally unanimous in what it does and says. So in the press conference, Chair Powell, he described the decision again, actually, as a risk management rate cut. So a small adjustment to guard against rising downside risk to employment. He stressed that the US economy remains fundamentally strong, which was interesting, of course, amid, of course, the recent government shutdown. And that hasn't changed the Fed's outlook at the moment. Really interesting that, because we've got to over a month now in that government shutdown, and we're now seeing some sort of payments really affecting quite a chunk of the US population. So just watch out for that if we go any longer with this shutdown. For the Fed, importantly, Powell, he made it clear that another, and this was key really for markets, another cut in December, he said, was far from a foregone conclusion. Really important that. Rate cut bets had priced in a December rate cut pretty much around 94% actually this time last week. And really that statement, far from a foregone conclusion about a December rate cut, sort of really did hit markets, and also underscored actually just how split policymakers are on what comes next. Powell also said rates have now entered what many at the Fed consider the neutral zone. So that's sort of 3 to 4%, where policy is neither stimulating nor restraining growth. He then also said he still views current policies moderately restrictive, or of course, because we're sort of at the upper bound of the neutral zone. Inflation continues to drift closer to target, with houses and services cooling, but still is elevated actually, while the labor market remains stable, though job creation has slowed. So that was the Fed really in brief terms. You can just see the cooler inflation, but still above sort of the month-on-month core rate. I showed you this last week, actually, the month-on-month core rate, still above what is needed over a prolonged period to get the target back to 2%. We need a monthly core a core month-on-month reading of 0.0 or 0.17 actually, so just below 0.2. We're not getting that really at the moment, so that doesn't it points to us still being elevated and above the 2% target. Interesting meeting, as I said. That far from foregone conclusion jumped on by markets, and really now the Fed is sort of not on autopilot. That's a sort of key takeaway, really. December meeting, much more open now, and certainly dependent on data. If we don't get data, then that is a tough spot for policymakers to potentially cut again at that mid-December meeting. Of course, if the economy holds up, long-term yields could climb again. And as I say, then the odds of a December rate cut now around 69% the last time I looked, actually, from though above sort of 90, 94, 95% it was before this Fed meeting. Interesting then, the market reaction, actually. I just want to get to that. Sorry, I should put you back on there before we look at the dollar index chart, actually. But the market reaction actually really interesting because it had a relative lack of impact on stocks actually. So the S&P actually closed flat on the day. It was down less than 1.01%. And the Nasdaq gained 0.55%. Really interesting that, because markets did react sort of dollar wise, but stocks didn't so much. And it sort of pointed to the fact that stocks rely more on really big tech and obviously AI more than sort of cheaper rates. And that is sort of encouraging actually for risk. Yeah, so that was a big takeaway for us. I think the stock market rally with the S&P up sort of 18% or so for the year has obviously come despite all manner of turbulence along the way, of course, and has continued despite disappointment on rates, really. So in September 2024, if you think about that, when the Fed initiated its policy easing cycle, really, with a jumbo 50 basis point cut, futures markets, they expected Fed funds to end this year below 3%. But now, of course, it's not sure if we'll get that low even by the end of 2026, actually, if you look at it now. So potentially that was going to be quite a headwind for stocks. And really the question would be how they would deal with it. But as I've said, stocks continue to go higher, and we're not potentially going anywhere near that sort of below 3% mark. Really interesting. If we just grab the dollar index chart just for your guide. Bear with me 1 second. So a little bit of an uptick, a few days of gains, actually, nothing major, but now we're pushing above some resistance that we had marked in. You can just see here then, dotted lines there. There's a swing low from 2023, 99.57, and then we've got a fib level of this move lower. That's at 99.51. So we're just above that now, interesting enough. We have next up probably this late July, August high around 100 spot 25. And then you've got the black line, which is a 200-day moving average. That's at 100 spot 45. So a couple of areas of resistance potentially, but yeah, a few consecutive days of gains and potentially bullish momentum picking up. Will be interesting if we get above these, the swing high from August, sort of July time, and then potentially above that 200-day moving average or not. Okay, that was the Fed. If we go to then, let's look at Eurodollar actually in the ECB. Nothing major happened with Eurodollar actually. Kind of steady meeting. Cap rates unchanged with the deposit rate at 2%, fully expected by markets and consensus really. And the monetary policy statement was short, really, mentioned the inflation outlook broadly unchanged, no guidance as expected again. The bank repeated the data dependent sort of meeting by meeting approach, and that was appropriate to determine the policy stance. The economic assessment by President Lagarde during the press conference, again, pretty much as expected. Very limited new information, actually. She noted the Q3 growth was higher than expected, said wouldn't really complain too much about that at this point. She did highlight some downside risks to growth, have abated actually since the last meeting, but then stressed the symmetry really of the 2% inflation target. Remains in a good place. That's what we said would probably be said. Policy, that is, remains in a good place. And that really resulted in pretty limited market reaction. We were then beholden really to the Fed, of course, follow through from that. And the pushback against the December rate cut, that meant the dollar strengthening, euro going lower, euro dollar going lower. And you could just see pretty much, remember that in the dollar index, the euro accounts for about 56% in that index. So if you flip this chart on its head, you get the dollar index really. So 4 consecutive days of declines. We've got to the 70.6 of this move higher. That's a 115.04. And then you've got that swing low from late July around 113.91. Below here, the black line again, the 200-day moving average, that's at 113.22. Okay, that was ECB, pretty steady as she goes, really, that meeting. Let's just get to the Bank of Japan. And here you can just see a chart with rates and where inflation is at the moment, which is here. Bank of Japan, they kept rates unchanged as well, like the ECB, but obviously in a different position at 0.5%. That was for the 6th straight time. We had the same vote split, actually, 7-2 as in this September. The two votes argued that inflation is nearing the target and that policy rates should be closer to neutral. So they were hawkish. The bank, well, they kept its GDP and CPI forecast broadly unchanged, though the increase in next year's fiscal year CPI core number from 1.9 to 2% is meaningful, and it stays above 2% actually for the next 3 years, driven by strong wage growth. That meant really the narrative of the bank remains the same. So they're preparing really for the next rate hike in due time. Between now and December, just to note, we get 2 months worth of additional data, and the market implied probability actually of a move by year end stands around 45%, I think, at the moment. We have had recent positive trade developments, of course, that should potentially give the Bank of Japan more confidence over the coming months to finally pivot again to a rate hike. Elevated dollar yen, of course, is also likely to add to inflationary pressures and potentially will be a concern for the Bank of Japan. All that said, of course, we did get the press conference by Governor Ueda, whose sort of commentary was relatively dovish, really. Doesn't mean the debt hike is off the table, and potentially that could happen with data which is stronger than expected, of course. We do have the domestic situation as well, with the new Prime Minister Takeichi seen as a monetary policy dove, but at the moment that isn't expected to impact policy too much. If we just pull up dollar yen then. Bear with me again, sorry. Yeah, here's dollar yen. You can just see, let's pull it back a touch. We've moved up now, sort of through that sort of resistance around 153, just above 153. Big move higher last Thursday on the Bank of Japan meeting, really, and post-Fed really was the key, with yields, US Treasury yields going higher. Interesting now where we go. We've got some fib levels in here. Around, where are we, 154.81 potentially, minor fib level of this move lower. Otherwise, those highs, year-to-date highs, actually at 158.87. You kind of think, where does intervention or verbal intervention happen? We're sort of getting that a little bit now. So between sort of 155, 160 was the previous sort of area where we would get a pickup in that intervention. But of course, it's about the rate of change, remember, not just the absolute level. So just if we do get sharp moves to the upside, then potentially watch out for the MOF, the Ministry of Finance in Tokyo, really looking at this quite closely. Otherwise, moving on from that, we did have the Bank of Canada meeting as well. Here's dollar CAD for your guide. They delivered basically a hawkish cut, actually. So they trimmed rates by 25 basis points to 2.25%, really amid sort of the mounting fallout from US trade actions, which have hit auto, steel, and lumber pretty hard. GDP, that contracted 1.6% in Q2, and unemployment at 7.1% now. That remains pretty elevated, with growth remaining sluggish. Inflation slightly higher than expected, though, but it is seen easing as household debt and weak exports weigh on activity. Interesting though, policymakers signaled they're near the end of the cycle now. That comes after 275 basis points of policy easing, rates easing really, and potentially now suggests the December pause, possibly before, well, leaving the door open if they need to a sort of rate cut in early 2026. There was a slight pushback though against more cuts, as I say. And dollar CAD did push lower after the meeting. You can see down at 138.87, but then the Fed hawkish sort of cut there from them outweighed the hawkish cut from the Bank of Canada, and you can just see now we pushed above the black line, the 200-day moving average at 139.44. Now we've got this resistance from these previous highs in October, near to 141, just below there, about 140.70 region. Could potentially offer resistance. Otherwise, then we get up to the halfway point of this move lower at 141.65. Okay, that's dollar CAD. Just quickly then looking at this week's main events. If I just pull up the Aussie chart. Yeah, the RBA meant to keep rates unchanged, actually, at 3.6%. Money markets pretty much agree with that, around a 90% chance plus of a pause, actually. But that was or has been a sharp shift from earlier last week when really markets saw a decent shot at another 25 basis point rate cut. Quick recap then, September, RBA held rates there. Inflation had dropped a long way from its 2022 highs, but underlying price pressures were proving still sticky. The central bank said risks were broadly balanced, really. Upside risk from strong domestic demand, but downside risks from consumers tightening their belts. Governor Bullock, she's kept the tone fairly flexible, really, suggesting future rate cuts could be on the table, but not committing either way. She was really waiting for more data before making the next move. That data, well, since that meeting, we've had weaker than expected jobs data. Unemployment ticked up to 4.5%. And then we've had hotter than expected inflation data, with quarterly and monthly CPI readings coming in firm, and the annual inflation number jumping actually to 3.2% from 2.1. So that's actually above the top end of the RBA's target band of 2 to 3%. That really shifted rate cut odds and really pushed back against them, and really gives the RBA more reasons actually to stay on hold. And we have had a lot of actually investment banks really pulling back their near-term rate cut bets, really, and some now thinking even that a February rate cut is far from certain. We're likely to get then a wait-and-see sort of approach by the RBA, steady hand really expected, although obviously the tone of the statement will be important, and any inflationary commentary about hints as to what the RBA do next will be seized upon by markets. As for the Aussie dollar, you can see the blue lines, the 50-day moving average, that's at 65.61 there. We've got that spike from last week at 66.17, and then you've got the 200-day moving average, which should provide very strong support along with that fib level. That's around 64.42. Otherwise then as well, we get the Bank of England meeting. I've just got a chart for you. I just want to speed up here. It's taking a little bit of time. So here's the Bank of England, and you can just see the base rate, which is the blue line at 4%, and then you've got CPI picked up actually, and now we're at 3.8%. With the target, of course, the dotted line at 2%. Expectations for the bank, then the MPC, they will keep bank rates at 4%, around a 30% chance of a rate cut. Those odds have changed more recently, and I'll get to that. Vote split expected to be a 6-3 against a 7-2 decision in September, where we saw dovish dissent from Dingra and Taylor. Yeah, the Bank of England really has been largely priced to be on hold, really, after the August meeting. That saw a hawkish cut. More policymakers than expected put their weight behind an unchanged move on account of concerns over the stickiness in inflation. Since then, we've had inflation. September inflation data, though, has come in softer than expected. The headline at 3.8 versus a 4% projection by the bank, actually, and consensus estimates. Um, in yeah, it's good news for the bank and for rate cutters, really, for the doves, but probably not enough to cement immediate action at this meeting. Obviously, inflation, as I've pointed out, still nearly double the MPC's 2% target, and wage growth still sort of inconsistent with the bank's mandate. Of course, the bank has been known to run for policy markets before, but really we've had nothing from officials really to talk up the policy, the possibility of policy easing at this meeting. And also we have the November 26th budget, which of course will be a huge event, and really we're building up to that. Press really reporting we could get potential tax hikes and a low growth budget, and that would mean then the Bank of England would have to take up slack with looser monetary policy. So really, policymakers, you kind of think will be waiting for that, and also then another CPI report potentially before making a move in December. Pretty high chance of that, around 60% chances of a December rate cut at the moment. We do get the quarterly monetary policy report, but that should, those are economic projections for growth and inflation. They should pretty much align with the August projections. So nothing market moving there. If we just look at cable, just finally. Just bear with me 1 second, just trying to pull up that chart. Let's just get cable. So that's sterling against the dollar, obviously. And cables, well, sterling's had a tough time, really, because of these rate cut odds increasing. You can just see we dip below the black line there, the 200-day moving average. So that's a 132.84. And we're kind of trying to cling to this level of support, which is that swing low from the start of August at 131.41. Which corresponds with a 38.2 retrace of this move higher. That's at 131.40 as well. So level of support here. If we do lose this, then potentially we go down to sort of 129.41. That's the midpoint of this move, this year's rally, actually. So the midpoint of that 129.41. Upside there, support at 131.41. If we do hold on to that, as I say, 200-day moving average at 132.48. And then the next fib level at 133.86. Yeah, interesting. Whether they do talk more hawkishly, then that could act as support for sterling, and we just hold on to this sort of 131.40 level. Okay, I'll wrap it up there. As I said, we do have ISM manufacturing and services data this week. Could be some importance to that, obviously, because of the lack of non-farm payrolls data that we won't get on Friday. We do get the ADP private payrolls data on Wednesday. Again, focus could be on that more because of the lack of non-farm payroll data. Around 25,000 jobs expected to be added, I think, there. And they will release, that's the monthly ADP data. They will release a weekly update on Tuesdays just for your guide. Okay, I'll wrap it up there. 44 minutes or so. I did say it was jam-packed. So really do appreciate you being on this call for all this time. Please do follow us on social media. Lots of different channels there. And we also do put out a daily commentary after the US close, which has a look at all US assets, the dollar, stock markets, look at the day ahead, and also a chart of the day. That goes up, posted onto the website, as I say, after the US close. Thanks again for being with us. Really do appreciate it, as I say. And please do tune in same time next week. Okay, take care.